Is a non-grantor irrevocable, complex, discretionary spendthrift trust the secret to never having to pay income tax again? No. Hi, I'm John Strohmeyer with Strohmeyer Law, where we help our clients leave no unfinished business. Now, you may be clicking on this video because you've heard that there may be a secret in Internal Revenue Code Section 643B that says capital gains, extraordinary dividends, all sorts of other wonderful magical tax goodies are waiting for you to be non-taxable if you just have the right kind of non-grantor, irrevocable, complex, discretionary spendthrift trust set up for you. The problem is this isn't true. This is a misreading of what Internal Revenue Code 643B actually says. Now, let's start at the beginning. What do these words mean, and do they actually mean anything by themselves? And the reality is, yes, these are good ideas. These are real trust concepts. The problem is when they get put together and packaged as a tax avoidance scheme, it lands you in hot water with the IRS. While the promoters of these schemes are saying that they have backup and reasoning behind their rulings and their advice to you that this will stand up, in August of 2023, the IRS Office of Chief Counsel released a technical advice memorandum detailing that, no, these are promotions that are not going to comport with the law. So let's start with all these words and what they actually mean. First, non-grantor. It just means that this trust is not actually a grantor trust. Now, there are two broad types of trusts for income tax purposes. Yes, there are many other types, but the big ones we think about are grantor trusts and non-grantor trust. A grantor trust is a trust that has certain rules that mean that the grantor of the trust has retained certain rights or powers with respect to the trust or its assets, and as a result, the grantor and not the trustee is subject to income tax on the gains, losses, and other tax attributes inside that trust. Basically, a grantor trust is going to be treated as a disregarded entity for income tax purposes. That's not exactly correct. It just means that the grantor trust doesn't exist as a separate taxpayer. In contrast, a non-grantor trust is taxed as a separate taxpayer from the grantor. The trustee files their own tax return, IRS Form 1041, to report gains and losses to the IRS. The interesting thing to note about grantor and non-grantor trusts, when you have a non-grantor trust, there are different ways that it can be taxed. We'll get to that in just a minute. But what you'll have is a separate taxpayer, and that separate taxpayer, the trustee, has its own income tax brackets. Generally, the non-grantor trusts are taxed, or they'll get taxed at the highest bracket much more quickly at lower income than an individual. And so you don't necessarily want to have a non-grantor trust. It's not going to be the most tax efficient way to report and pay income tax. Next, irrevocable. Again, nothing weird or strange. We set up irrevocable trusts all the time. Sometimes you will set them up while someone is still alive. This would be an irrevocable inter vivos or lifetime gifting trust, where you're setting something up and basically saying that because it's irrevocable, means it can't be revoked. The grantor can't say, well, you know what? I'm taking everything back. I'm going to revoke the trust and put it all back in my pocket. Now, the power to revoke is one of the ways that you can have this be revocable. And it's also something that lines up with how a grantor trust is treated as a grantor trust. So when we set up an irrevocable trust, we're basically saying we're putting this together, and one of the options is it's going to be a grantor trust or it's going to be a non-grantor trust. Now, a revocable trust is something that is a common trust option as well. You'll see revocable management trusts used in states frequently as probate avoidance tools, where those states have difficult, cumbersome, lengthy, expensive probate processes. Think Florida, New York, California. They get used a lot there to avoid the probate process. Other states, like here in Texas, revocable management trusts aren't unheard of. They just get used less because the probate process isn't as cumbersome as it is in those other states. So again, irrevocable, there's nothing weird or wrong. These are trusts that we set up sometimes at lifetime. Sometimes they're set up in last wills to be created when somebody passes away. but it just means once we've set this trust up, we're not really going to change it anymore. Next, complex trust. Now here we're getting back into the income tax characterization of this trust. This is meant to differentiate a non-grantor trust that is complex, and it's not what is known as a simple trust. Simple trusts are kind of rare. You can have a trust that is simple trust 1 year, perhaps, and a complex trust in the next year. The main requirement to be a simple trust is that it's going to have to distribute all of its income annually, and it can't distribute principal and can't make any distributions to charities. If it hits any of those 3 requirements, then it's going to be a complex trust, and it's going to have to file a different form of income tax return. Basically, it doesn't have simple rules. We just have to do something different. So a complex trust is not a weird thing. It's a trust that doesn't have to distribute all of its income. It potentially made some gifts to charity, and maybe it distributed some of its principal. This happens all the time. Again, for trusts, this is what most trusts look like. Again, they're going to file IRS Form 1041 to report their income losses, deductions, credits, and etc. So we've talked about trusts that are non-grantor. We've talked about trusts that are irrevocable. We've talked about trusts that are complex. What about discretionary trusts? This also not a weird trust word. Trust can be discretionary. This means that the trustee, the person in charge of making distributions from the trust, has the discretion to determine how much gets distributed. Now, the specific amount of discretion that trustee has will vary depending on the trust. That discretion may be over trust income, may be over trust principal, may be over both. There may be a specific standard that the trustee has to look at when they're making those distributions. Typically, we'll use the Health, Education, Maintenance, and Support Standard, or the HEMS standard, when determining how to set up a trust. That's our starting point because it works to limit estate tax consequences for the beneficiary if they're also serving as the trustee. If you want to think about something that's non-discretionary, you may have a standard that says that the trustee is required to distribute all income every year, no more, no less. However much income comes into the trust, that's exactly how much goes out. Alternatively, it may be that the trustee has to distribute $500 every year and it comes out of income first. And if there's not enough income, you start dipping into principal. That's where we're taking the discretion out of the trustee's hands and leaving it with the person who drafted the trust. Again, there's not a right or a wrong answer. There's not even a question so much of, can you do this? You can. It's how much, when you set up the trust, discretion are you going to give to that trustee? So a trustee with discretion, though, is probably going to end up being a complex trust. Why? The trustee may not distribute all of the income. They may distribute some of the principal, and they may make a distribution to a charity. So discretionary and complex almost go hand in hand. And that's okay. Again, none of this so far is weird. There's nothing to think about. Finally, we're going to come to spendthrift, this fifth magic word that people think they have. It's a type of trust set up so that when the grantor has put assets into the trust, they're doing it to try and protect the beneficiary from creditors' claims. Now, when somebody's giving something away, they can put rules and regulations, trust distribution standards on it to prevent the beneficiary from coming and accessing that trust asset. With the idea being then, if the beneficiary can't get to it, then the creditors of the beneficiary should also not be able to access that. And that's where that spendthrift protection comes in. Typically, we'll see parents who are setting up testamentary, non-grantor, complex, discretionary trusts for their children, saying this is a spendthrift trust, meaning that it's protected as much as possible from future predators, creditors, ex-spouses, people who are going to try and get their hands on the assets inside that trust. Generally, this isn't a problem. Where this can get complicated is self-settled spendthrift trusts. In a lot of states, you can set up self-settled trusts, but it's not going to protect you from your own creditors. Taking your own asset and putting it into a trust for your own benefit generally is going to run afoul of the fraudulent transfer restrictions. You're going to, here in Texas, if you set up a trust and you're the beneficiary and you fund it for yourself, you're generally not going to get any creditor protection from having done that. Now, Texas has lots of other ways to protect your financial and other assets from creditors' claims, but setting up a trust for your own benefit really isn't going to be the way to do it. There's not some way to just say, here, I'm going to have all of my assets, be able to spend them, but protect them from my creditors as well. And so what do we have? These non-grantor, irrevocable, complex, discretionary spendthrift trusts. Sure, you can do this. There's nothing particularly magic about it. We're doing these and setting these up all the time. The problem is these are being sold as some magic tax avoiding scheme. And this is where we get to Internal Revenue Code 643B. Now, this is a definitional section that provides clarity on what is treated as income, not taxable income, not any other sort of income. And it really says that when you're talking about income without any further clarity or further definition or adjectives on it, it means fiduciary accounting income. And this is something that is separate from taxable income. Fiduciary accounting income is determined on a state level and looks specifically at the trust document and state law to say, here is what will be treated as income when received by the trustee versus what will be allocated to trust principal. What trustees have to do is every time they have a receipt, they have to categorize it as either trust income or trust principal, with trust income generally being used and made available to the current beneficiaries, and trust principal generally being reserved for later or remainder beneficiaries. Again, the trust agreement, state law may change what gets allocated to different portions of either principal or income. But think about it this way. If somebody makes a gift into a trust, generally that's going to be treated as trust principal. So if mom makes a gift of Exxon stock into a trust, that's going to be trust allocated to trust principal. If that stock generates a dividend, well, that's a return on that trust asset, on the principal of the trust. That's going to be treated generally as income, and that dividend will be taxed as ordinary income to the trustee. Why do we care about this? Well, fiduciary accounting income goes into a larger calculation. So why do we care about the distinction of fiduciary accounting income for trusts? Why is this in the Internal Revenue Code? It's in there because it goes into a more complicated calculation for distributable net income. Trusts are not magical tax eliminating vehicles. You'll hear people who say that with this one magic trick, you can get rid of that taxable income. It's not going to happen. Trustees, executors, other fiduciaries are still responsible for paying and reporting tax just like any other individual. Internal Revenue Code 641A will help you see that. 643B is important because it's saying that fiduciary income, when we're not talking about taxable, distributable net income, undistributed gross income, means the amount of income, fiduciary accounting income for that trust or estate determined under the governing instrument or applicable state law, but we're backing out extraordinary dividends, taxable stock dividends, capital gains, because those generally are allocated back to principal, so they're not going to be included in fiduciary accounting income, not taxable income. This is how we determine what amounts are being passed out to beneficiaries when we're allocating the taxable income between the trustee and the beneficiary for federal income tax purposes. Now, this goes into, well, again, we're allocating who is going to pay the income tax on it. If it's something that's normally treated as trust income for fiduciary accounting purposes, and then it gets distributed out to the beneficiary, well, the beneficiary is going to end up paying the income tax on it. If it's instead something that's normally withheld as part of principal, and the trustee is going to hold on to it, well, then the trustee should be paying the income tax on it. It goes to a larger idea of how trusts are taxed. There's one layer of tax between the trustee and the beneficiary, and it gets allocated to only one of them, so we're not paying double tax. What we're not doing is setting up a situation where you can get a tax exemption. Once it's in the trust, well, the default is going to be until it leaves the trust, that trustee is going to be responsible for paying income tax on it. If it gets distributed out to the beneficiary, especially if it's income, generally it's going to be subject to income tax at the beneficiary's in specific income tax bracket. Now, there's some options to allocate who pays the tax and how much you pay, but there's not an option, and 643B isn't saying that you exclude it from taxable income. It's saying it's being excluded from fiduciary accounting income so that it's subject to income tax at the trustee level and not the beneficiary level. So again, putting this all together, non-grantor, irrevocable, complex, discretionary spendthrift trusts are things that exist. What they're not going to do is eliminate your income tax. 643B is a way of allocating the taxable responsibility between the trustee and the beneficiary as part of a larger calculation of distributable net income, but it's not an escape hatch to no taxes forever. If you're being told that this is some magical wand to eliminate your income tax, put your hand on your wallet, run the other way, you're probably about to get yourself in some hot water with the IRS. So we've got a lot more videos here. Don't forget to like, comment, and subscribe. Thanks so much for watching.